I'm Louis, as many of you know. I am at Entre Trámites. We cover everything to do with Spanish tax and all the complications with moving here, migration, and tax-wise. Now, on the other hand, we are joined by Vincenzo from Online Taxman. Vincenzo, if you could just give a quick brief about yourself, because I'm sure you'll get it much more concisely than I will.
Yeah, no, listen, I'm Vincenzo Villamena. I'm a US CPA and focusing on taxes for Americans living abroad, as well as foreigners that invest in the United States. Obviously, working with you all on the US Spanish tax implications, as well as just, US expats around the world.
Thank you very much. And yeah, so today we're hoping to address some of the tax considerations which might come up for US nationals looking to cross overseas, considering Spanish jurisdiction, but also when you might be considering any other overseas destinations, because lots of the same issues apply whether you're moving to Spain, whether you're moving to Italy, whether you're moving to France, whether you're moving to the UK. Lots of these same considerations come up for US expats moving overseas. So to kick off, Vincenzo's going to give a little bit of an overview and share and present. And then I will go to briefly touch on the Spanish nuances. Please, Vincenzo.
Yeah, let me share my screen. Oh, it's not. Let's turn on camera. And then we could go through. All right. So again, we're going to talk about U.S. taxes, specifically for Americans living in Spain, and just sort of a high-level overview, and then followed by, we'll go into obviously the Spanish side. But to sort of kind of go through it from a high level, there's a few standard expat tax strategies that we help people with that would go through the foreign income exclusion, also the foreign tax credit, and then looking at like treaty benefits and whatnot. And there's a lot more that you could do, especially for Americans living abroad and people that are investors or entrepreneurs. Of course, everything also needs to be validated on the Spanish tax side. So I'll sort of talk a little bit high level. And over generally expat taxes, as I'm sure are aware, expat tax can be complex. You have, of course, not just reporting in the United States your income, but also FATCA, like reporting foreign bank accounts, assets, et cetera. Of course, looking at the local taxes, in this case in Spain, and potentially double taxation, as well as just sort of trying to optimize based on these tax laws on both sides. From my perspective, we've helped thousands of people save money. Things, a few different examples: switching state taxes, so no longer paying state taxes, looking at things like structuring via trusts, of course, looking at filing statuses and the right business structure, and also just retirement planning, right, like Roth IRAs or traditional IRAs. And to give a bit of background on myself, again, I'm the founder of Online Taxman. I've been doing this for over 15 years, and also, have sort of worked and lived abroad for over 15 years as well. So I'm not just sort of an expat tax accountant, but I lived that life as well. I'm currently based in Rio de Janeiro, Brazil. So looking sort of at some of the tax saving strategies we'll cover today. For individuals, it's things like the foreign income exclusion, the foreign tax credit, FATCA and whatnot. And then for entrepreneurs, there are things like the S Corp election and accountable plan and offshore structure. But again, some of those structures, although might be optimized for the US side, might not make sense for Spain. And so that's another thing to be aware of that we'll also go through. I think the biggest question that a lot of people ask is, should I file, right? And, as a US citizen or green card holder, if you have a minimum threshold, in this case, it's $14,600 for singles, or $29,200 for married filing jointly, you have to file. I think the interesting part is that if you're married filing separately, right? So for example, some people might be married, but they have a spouse from Spain or from, non-American. and hence or don't want to include that person on their tax return for various reasons. They don't want to report their income or their assets or what have you. Then that threshold goes down to only $5, right? So if you're married filing separately and you're not reporting your spouse on the tax return, then your threshold is extremely low. I think the other aspect is, you might have to file a state tax return, right? And this is related to, ties that you might have with your former state. And name a few states where there are a lot of strong ties, I should say where the ties are strong and the states can be relatively aggressive, or states like California, Virginia, Illinois, Massachusetts. And so really, I think it's important to cut ties with your state. So, not having a driver's license, not having any mail delivered to that state, particularly tax documents, and just overall, cutting ties, right? I mean, if you have a house there, you should either sell it or make it a full-time rental property. You should be moving your belongings out of that state. You're really cutting any sort of social ties, cultural ties, even not having any doctors in that state, things like that, to really show that you're not living in that state anymore, right? And the final thing is, if no matter where the income source, if it's U.S. or abroad, right, and even if you're paying taxes locally in Spain for this matter, you're still required to file your U.S. tax return if you meet those thresholds above. So, a lot of people sometimes aren't aware of those obligations. Now, from a standpoint of tax breaks, we'll go through four things. One is the foreign income exclusion, foreign housing exclusion, and the FTC and tax treaty benefits. So, foreign income exclusion, you essentially get $126,000 tax-free. That's for 2024. For 25, it's actually 130, so it keeps on going up. And in order to qualify, you either need to be a bona fide resident, in this case in Spain, or it could be anywhere else, or a physical presence test. And so it's either or here, right? You don't have to qualify for both tests in order to get the $126,500 tax-free. So the first thing is, what is foreign source income, right? Foreign sourced is earned income, right? So if you are, let's say sitting in Spain, performing said task, said job in Spain, then this is foreign source income. So it doesn't matter if you're working for a U.S. company, if you're getting a W-2 job, you have your own consultancy, contractor. It doesn't matter if it's going into a U.S. bank account from a U.S. company. The fact that you are working outside the United States means that income is sourced, and as such, it is not subject to it's subject to the foreign income exclusion, and you could not pay tax on that money. However, the distinction to note is that it has to be earned income, right? And so any type of income like capital gains, dividends, interest, rental income, this is all passive income, right? So this does not qualify for the foreign income exclusion. As well as if you're retired, earning any type of pension, whatnot. Again, that is not earned income, and that's not qualified for the FEIE. Right? But to go into it, like I said, there's two tests. The bona fide residence test is for people that are living outside the U.S. So if you decide to move to Spain, you have a long-term visa, and you could be, of course, paying local taxes. Again, these sort of social, cultural, religious ties. Of course, having a long-term lease, having a utility bill, any other documents. And I think it's important, if you are going to claim the bona fide residence test, that you do have a few documents to show that you are, in fact, living outside the U.S. in case the IRS asks. But this will allow you to qualify for the foreign income exclusion. And by doing so, you get that first $126,000 tax-free. And by being a bona fide resident, it does allow you to go back to the United States for 2 to 3 months a year, right? So it gives you a little more flexibility than the physical presence test, right? And the physical presence test is the other way to qualify for the FEIE. And this is a very straightforward, bright line test of 330 days outside of the United States. And so if you're outside the US for 330 days in a 365-day period, then you would qualify. And that doesn't necessarily have to be a calendar year. So you could be, let's call it July 1st to July 1st of the next year. Again, you've only been in the US for 35 days during that 365-day period, and you can qualify. Of course, it'd be a partial year, half of year one, and then basically the half of year two. But again, you could qualify, and obviously continue to take the FEIE after that 365-day period has expired if you continue to live abroad. An important aspect to know is that travel days count as a day in the United States. So if you, let's say, take a 11:30 p.m. flight, out of New York or Chicago to Spain, you're still in the United States. Let's say once the clock strikes 12, or let's say it's from Chicago. So, you're still over U.S. Territory when the clock strikes 12. So then that would still be a travel day in the United States. So I think it's super important, if you're going to do the physical presence test, to leave a little bit of buffer so that, if you happen to be in the U.S., an extra day or two, you're not pushing up against that 35-day time requirement. So you're not going to miss out on the foreign earned income exclusion, because obviously that could be a very costly mistake. Now, the foreign tax credit, I think it's important because it really does, provide a dollar for dollar tax credit to taxes paid to foreign governments, right? So in this case with Spain, if you are paying taxes to Spain on your salary there, on, just living there, maybe you have an investment in real estate or what have you, Spain generally would want to get first bite out of that, right? Because you're a tax resident of Spain. And so the point is, for any tax that you pay in Spain, you would get that same credit in the United States. Of course, this would be, against non-excluded income, right? So basically, any income that might be in excess of the FEIE. So if you, let's say, only earn $90,000 and you pay tax in Spain on that $90,000, but also took the foreign earned income exclusion, you wouldn't take that tax credit against any income in the U.S. because at the end of the day, that 90K was already excluded under FEIE. So you sort of have to be aware of that. And, again, sometimes the foreign tax credit might even be better than the FEIE, like in a high tax country like Spain, right? It might allow you to get a child tax credit in the United States or contribute to a thing like a Roth IRA. So I think it's always important to, really look at one situation individually, right? And again, especially when you are living in a high tax country like Spain, because generally, 9 times out of 10 or 99 times out of 100, you're going to pay more taxes in Spain, and you're just going to get the foreign tax credit in the United States. The foreign housing exclusion, again, is for expats that are employed abroad, and basically says that, if you're paying, in this case, over $20,000 in rent in Spain, then anything over that amount would add to your foreign earned income exclusion. So let's say you're paying, $30,000, right? So basically, 30,000 is above that, 20,240. So basically, about a little under 10,000 could be added to the 126K foreign earned income exclusion. So basically, your total excluded income will be around 135, right? And so basically, what this does is it sort of evens the playing field for expats that are in high cost of living areas to give them an additional tax benefit. Again, if they're paying over, in this case, or in 2024, $20,240 in rent. And just to be very clear, these type of the qualifying expenses would be, of course, rent, utilities, any other sort of repairs, residential parking, rental of furniture and insurance, et cetera, right? So again, if all these expenses add up to roughly over 20K, then you could have an additional exclusion called the foreign housing exclusion. I think it's also important to note that, for people that own their property, where they live, in Spain or wherever, and you're paying mortgage and property tax, that will be deducted on Schedule A. So that's essentially very similar to the treatment of somebody in the States, right? It would be an itemized deduction. Now, going a bit specific into U.S., Spain, and the tax. I know Lewis will get into this a little bit more in depth, but there are a few exemptions or specificities. I think the one thing is the U.S.-Spain tax treaty. It allows for a lot of foreign tax credits, but it doesn't technically really have a lot of let's call it like very nuanced language that some other tax treaties have. So in other words, it's a very kind of and one way to say it, like plain vanilla tax treaty, right? It sort of says, hey, if you have retirement income or pension income, it's taxed in Spain, then you could receive the credit in the U.S., right? And this even includes like a Roth IRA distribution. So if somebody were to have a Roth IRA, which in the U.S., if you take that distribution upon retirement, that's not taxable, but in Spain it would be, right? So there's not any sort of special exclusions for things like Roth IRAs or, some other countries like Portugal, maybe U.S. doesn't tax Social Security, et cetera. In Spain, Spain is going to want to tax you first, and then the U.S. will of course want to tax you afterwards, or at least take the foreign tax credit in lieu of that. So I think the biggest. Go ahead.
Just to add, just to amend one thing very closely there. On the Spanish side, they've got an interesting treatment on Roth IRAs, where the communication we've got on the tax authorities on this is actually that Roth IRAs are treated like brokerage accounts. So they're not taxed on the distribution, but they're taxed on the capital gains, interest, and dividends. So they get treated as a non-shielded account. So basically, because there's no particular wording on the treaty on it, whereas IRAs and everything else are completely in alignment on that, Vincenzo. Problem is the Spanish tax authorities gave differential responses initially, but basically the standard Roth IRA treatment is basically that they just treat it like a regular brokerage account. So you end up paying on interest, dividends, and capital gains, Spanish tax, which of course in the US, you'd be paying nothing because Roth IRAs are shielded and excluded. But it's very important on that when somebody makes a move, right? If you're shielded in the US and you're going to move to Spain, realize those capital gains while you're in the US. Because you can realize them within the Roth IRA, and then you're not going to be paying tax on those gains once you leave. Sorry, just wanted to cut across just because that was a well nuanced little bit on the Spanish side.
Yeah, well done. And I think that's fair, right? I think it's to your point, like there's a lot of nuances, especially when you move abroad, and you need to be aware that what could be a tax shield in the U.S. or even sometimes locally might not apply to the United States or vice versa. I think the one shield is they do have a Social Security totalization agreement, right? And so just to be very clear, a lot of times, even though there might be a tax treaty between two countries, there's not a totalization agreement. And so a totalization agreement is sort of like a tax treaty, but for Social Security. And so in a lot of ways, one might, pay these type of taxes in Spain, and then again, not be subject to like self-employment tax or FICA in the United States, or, even vice versa. And so I think that's a nice facet. When it comes to structures for entrepreneurs, et cetera, again, I mean, the U.S. LLC is taxable in Spain because it is a look to it as a disregarded entity, right? So that's fully taxable, and as is S corp income, right? Because S corp is like a flow through entity, or that income's flow through to one's personal return, right? And so that's not going to be as, let's call it, tax optimized as potentially another structure, as long as there's an ability to do economic substance outside of Spain. So, for example, like a U.S. C corp, where maybe you have a U.S. office or employees, obviously potentially other low tax jurisdictions in Europe or elsewhere, and I'll let Lewis talk to it more during his presentation. But I think it's important because, again, this is another example of where a structure or strategy might be tax optimized in the United States, but then as soon as one moves abroad, all of a sudden, those sort of tax optimization strategies are, subject to be changed because of obviously local tax laws. Just go through a few other important aspects. Again, exchange rates is an important side, and on the U.S. tax return, you have the ability to look at it, daily or monthly or for the year. And I want to get into another aspect of living abroad, which is important, which is foreign bank account reporting, right? So if you if you have a bank account outside the United States over $10,000, you have to report it to the IRS under the FBAR, or even in aggregate. So let's say you have one bank account that max balance is $5,000, and another one where the max balance is $6,000. Again, in aggregate, it's $11,000. So now you have to report both accounts. So you have that, and then you have something called the Form 8938, which is a different form, and this is, again, for people living outside the United States. The threshold is $200,000 if you're single, or $300,000 or $400,000 if you're married filing jointly. In the U.S., you could see it's slightly lower, but it's a more inclusive form. So while the FBAR is only foreign bank accounts, 8938 can include foreign pension funds, mutual funds, even loans to foreign persons, any interest in foreign entities, foreign companies. So it's a way broader form, and obviously as such, it has a higher threshold. I think a big question, of course, is, well, what's not reportable? So if you own foreign real estate in your name, that's not reportable. However, if it's through a foreign entity like a Spanish company, then it does become a financial asset, and it's included on 8938. Again, any sort of physical gold bars or bullion in a vault, reportable. But if it's this sort of gold money financial account, that it is a safe deposit box at a foreign bank, and then also any assets under the name of a foreign spouse. So one might have a Spanish spouse or whatever, and they have assets or bank accounts on their name. That's not reportable, right? As long as they're not, of course, filing jointly with you. And so I think that's one way that people do sort of tax optimize or want to report less, by putting things under their spouse's name, if of course you feel if the trust is there. A few quick things. Self-employment tax is not avoided with foreign earned income exclusion, but again, if you're paying this sort of self-employment, Social Security in Spain, then you could get out of it with the totalization agreement. Again, the LLC is a disregard entity, so that income passes through to its members. But again, in Spain, it will be taxed anyway. And so I don't want to go through this too much, because again, this type of tax saving essentially would be negated in Spain, unfortunately. But for a lot of people that are entrepreneurs and Americans, an S corp is a great way to save on this self-employment tax by making that conversion. I think that anyone who has $40,000, $50,000 in net income should consider converting to the S corp. And same thing with things like the accountable plan, being able to reimburse for expenses related to home office or any other sort of employee expenses is another great tax saving strategy. And then also offshore, right? Again, I know even going through this, everything is subject to the local tax application. So, having a U.S. C corp owning potentially a BVI company or a Panama company, I think with Spain, maybe, owning a company where the jurisdiction does have a tax treaty with Spain just to avoid any sort of issues is important. But at least on the U.S. side, you get a 10.5% reduced tax rate from 21%. Of course, vetted asset protection and your salary could also be excluded under FEIE. But again, I think, to the previous point, at least on the Spanish side, you need to be able to show economic substance outside of Spain in order for this structure to work. So again, if anyone has any questions about these strategies and obviously what we talked about on the U.S. tax side, happy to help. We have a team and we really actually have a lot of clients in Spain. So obviously we're very well versed on these sort of cross-border thing and of course work with Lewis and his firm on this. So I'll let you take it away so we could keep on going. And then if there's any other questions, happy to help.
Thank you very much, Vincenzo. And yeah, the S corp, although a potential decent thing for lower earners who might be able to use it by switching across from LLC to S corp and then maybe using a certificate of coverage to be posted for the first couple of years. In general, it is inferior to the autonomo LLC combination because under Spanish rules, you will be taxed on your LLC distributions or your S corp distributions. So either way, your draws are taxable on a Spanish perspective. Now, the C corp and the offshore structuring is definitely an attractive option, what you just structured before, for entrepreneurs who might have employees, contractors, and everything else where they can build up profitability. But for my next part of the presentation, I'm going to take a step back and just go into a couple of the basics and a couple of the basic considerations. So I will just share screen now. There it is. Start slideshow. So, okay. First step, hang on a second. I'm not sure I'm moving to Spain. I'm still in the US. I'm not necessarily sure I'm going to be living in Spain. Maybe I'm just going to be there for a bit. Maybe I'm going to buy myself a property, or I've got some investments in Spain. So you live less than 183 days in Spain. Spain tends not to view you as a tax resident. They've got a double tie where basically what they say is if you are in Spain for more than 183 days, in almost all cases, we're going to consider you tax resident. If you're in Spain less than 183 days, but you have significant family ties, such as your kids, partner, them and their schools are all in Spain, even though you are outside of Spain, you may be regarded tax resident. But in general, the rule works broadly as follows, that if you are less than 183 days in Spain, because you've only just moved to Spain, or because you are traveling in and out for partial work, you will not be taxed on your overseas assets because you are fundamentally not tax resident in Spain. What will you pay in Spain? You'll pay the non-resident rate of taxation. Now, the non-resident rate of taxation, if you live and a tax resident outside of the EU, is 24% on Spanish salary, 24% on Spanish rental income with no deductibles, no mortgage interest, no nothing, and 19% on Spanish dividends, capital gains, and bank interest. Now, under most double tax treaties, the capital gains withholding would disappear if you can prove you're living elsewhere. But Spanish dividends and bank interest are often only, even with double tax treaties, only will get reduced down to 15% withholding. And sometimes it's not worth the argument to get back the 4%. Now, if alternatively you've been living in the EU as a US national, you would need to pay the 19% tax on Spanish salary, 19% tax on Spanish rental income, but you would be able to apply deductibles. The the tax rate on dividends, capital gains, and bank interest are unchanged. So, what happens if you are resident? Well, if you are resident, it's the flip side. Oh, let me take a step back. In this case, with the 19 to 24%, let's say you were tax resident in the US, and let's say you had some rental property in Spain. You would get a tax credit on the income you got from the rental property in Spain, which will reduce your tax bill in the States, as Vincenzo laid out with the foreign tax credit. And equally, if you're a US national living in Brazil and you own Spanish property, this foreign tax credit is also useful for your US taxes. Now, what happens if you live more than 183 days in Spain? In this case, Spain will almost always regard you as tax resident. What does that mean? You're taxable at a variable income tax rate on global salary from 19 to 47, 48%, a variable income tax on global rental income. Deductibles are allowed if you are tax resident. And the tax on global dividends, capital gains, and bank interest are 19 to 30%. Now, critically, it's 19 to 23% on the first 200K, but then above 200K, the tax rate really starts to spike. What about overseas? Well, in most jurisdictions where you'll have assets, and most commonly in this case, let's say you've got some US property which is rented out, maybe you've moved across, you rented out your family home. Well, that rental income would be taxable in the States first, and then in Spain, you would get a tax credit, which you could then apply with on that taxed income. As the asset is located in the US, you would do your US filing first. Now, in terms of general taxation, to give you an idea, I've broken everybody down into three separate groups: employees, the self-employed, and limited companies, SMEs. In the case of employees, there's a social security fee or tax, which is levied, and that varies between €300 to €600 a month. There is a progressive income tax, which ranges from 19 to 47, 48, 49%, depending on your region in Spain. However, under all the complexity, when you combine Social Security and income tax together, you actually end up with a very flat schedule. It's pretty much a 33% tax rate, which then above €60,000 jumps to around 47%. Now, how can that be if you've got a complex progressive scale and you have Social Security? How can it be that you end up with a flat income tax rate or a practically flat one? The reason being is Social Security is regressive while income tax is progressive. So let's say you make €15,000 as self-employed. In Spain, they'll make you pay €3,600 in Social Security tax, or 22, 23%. If you make 150,000, they'll make you pay 7,300. So your tax rate's dropped from 23% to around 5% on Social Security. So as you can see, Social Security drops over your income. Whereas income tax does the opposite. Income tax, the first 7.5K is untaxed, and then the tax rate gradually climbs from 19 to 47%. When you combine these two scales together, it almost perfectly works as a 1 in 3 euros in taxes jumps, then 47%. So this is the Social Security and progressive income tax rate. Additionally, and this is an important consideration for lots of US nationals who'll be moving across, in Spain, there is a VAT and sales tax on almost every service. However, if you do B2B consulting, any form of B2B services work for companies in the US, companies outside of the EU, in almost no scenario will you need to charge VAT. VAT does need to be charged if you've got Spanish origin clients or if you have retail clients outside of outside of Spain. For instance, you do a live yoga class for a student out in the UK. That will be considered as if it was provided in Spain, as if that person got on a flight, turned up, was sitting next to you, and therefore it is taxable in the location in Spain on that service under VAT. However, if your client's B2B consulting, B2B services, there is no need to worry. Within the EU, as long as your client has a VAT number, you will not need to charge them VAT if they are outside of Spain. And if they're a business and they charge VAT, and you charge VAT to that client in Spain, they can reclaim that VAT. Unlike the US, filing is quarterly and Social Security payments are monthly, so there is a slightly higher paperwork burden for the self-employed. For limited companies, it is pretty much the same story. In Spain, you form a structure called an autónomo societario when you've got your own limited company. But critically, in Spain, you do not have an LLC equivalent. All companies are similar to C Corps or Incs in their tax treatment. As such, all profit is taxed at the company level under a corporate income tax rate, which for the first 2 years is 15%, but after the first 2 years will jump up to 23 to 25%. Now, finally, if we look at the case of employees, let's say you've moved for a job opportunity, or you, let's say, are teaching at a local university, taxation works as follows. Income tax, exactly the same as self-employed. Social security is different. So social security is 32% on the employer for the first 60K, so much higher than you'd be used to back stateside, and 6.5% on the employee on the first 60K. Once it hits that limit, you will only pay 1% employer social security above that and only 0.2% employee social security. Critically, what does this mean? The cost of employment is significantly higher, and on costs are very important to think if any of you are thinking of setting up a venture in Spain. So although labor costs are significantly lower and you can get very good talent, you may face issues with the higher level of additional on cost. And this might also be why you see that salaries are a little bit lower than you might otherwise expect. Now, I'm going to skip over that and just get into deadlines if any of you guys are already in Spain. So if you're already in Spain, if you don't know that we're within income tax return season, this is the news call for you. You are in income tax return season. So you can make online filings from April 2nd to June 30th. By telephone, you can make your filings between May 6th to June 30th. I do not advise anybody to ever try and file any form of tax by phone in Spain. Okay? If the people in the office are unfriendly and not very useful, the telephone option in Spain is an absolute disaster. Do not try, you're just going to be stuck on hold. So I would recommend either using the online filing service, using a digital certificate, or going in person. Of course, if you've got overseas income from the US, you need to declare certain withholding taxes or anything else, we highly recommend using a filing agent such as ourselves. Now, some of you may have heard of another tax beyond income tax and social security, of the wealth tax. Now, unlike the US, Spain has a wealth tax based on people they perceive to have very high levels of assets. This varies by autonomous community. If you have more than a couple of million of assets each, we highly recommend, so if you have, let's say, between 1.5 to 4 million of assets, we highly recommend considering Madrid, Andalusia, the Balearic Islands, Cantabria, or Murcia as an option to live in. Why? Because there is a 3.7 million euro exemption from the wealth tax individually. If your assets are a bit lower, let's say you're below 1.5 million each, even though the wealth tax is a pain point, it isn't necessarily high enough that it should be your sole driver or decisive factor in deciding where you should live in Spain, because there's plenty of trade-offs. In Catalonia, for example, the wealth tax has only a 500,000 euro deduction. This means if you own more than 500,000 euros of assets, you will be taxed in Spain on those assets annually. Vincenzo, you had a point.
Yeah, I was just actually very curious about the wealth tax. Is there a way to potentially, in the U.S. for like estate tax purposes, et cetera, we put certain assets in a irrevocable trust, right? Whether U.S. onshore. So and the whole notion from a U.S. perspective is, well, now I no longer own those assets, right? The trust owns it, and my beneficiaries, which is generally one's kids. Would that sort of thing apply to potentially lower your asset value in Spain because you no longer, own said assets? It's in a trust.
So this is a very interesting element. So trusts are largely non-recognized outside of common law jurisdictions.
Okay.
What does that mean? They see through them. So what they say is, okay, it's an irrevocable trust, but who is the beneficiary of the irrevocable trust at this point in time? They would view that as the owner of the assets, even if they don't have free will over what happens with those assets. However, Vincenzo, exactly what you're touching on can be very relevant for, let's say, retirees who might have kids getting up on life, potentially grandkids or anything else. One of the things we do discuss with clients is the classic part of going, okay, look, you've got $6 million each, you're 75, you're about moving to a country where your cost of living is significantly lower. you've told me already that your intention is to leave your assets for your kids. Have you considered putting 2 million, 1.5, into an irrevocable trust for your kids, which pays out a little bit every year to them, and pre-set up for what your intention is? Now, there's obviously the sacrifice of control in this factor, and unlike other structures, there are some other ways of reducing the wealth tax. But for most people, if they don't have their own limited company or anything else, this is one tip that we've used. Vincenzo, please.
No further questions.
No further questions for now. Okay, please come in if any on that, and I will open for questions in 5-10 minutes for anybody else who'd like to come and tear any holes in what I've presented so far. The basic issue on this is if you've got more than 500,000 euros, you will face a wealth tax. Now, initially, so let's say you've got 800,000 euros, 877 euros a year is not enough to deal with complex tax structuring. It really is not worth the hassle. However, when you get up to about 1.3 million, which is after the 500k deduction, so about 1.85 million, we're talking about 9,000 euros or $10,000 a year in taxes, on top of the income tax you're paying on interest, dividends, and capital gains. This really starts being more notable. And when you think, oh, well, if I just move to Madrid or choose Murcia or Andalusia, I can avoid paying this. Particularly, let's get onto the point where you have 2.7 million of taxable assets. So this could be you have 3.2 million euros, $3.5 million built up in your IRA, your cash, your overseas property, and suddenly you're looking at a 27,000 euro a year tax, 30,000 bucks. This suddenly becomes an amount where you start to consider, well, I do like Barcelona a lot, but maybe Malaga might work for me, or maybe Madrid. So if you have a higher level of asset base, it is worth considering geographically where you want to be based. Beyond that, what are the other taxes which vary dramatically? Inheritance and gift tax. So in Spain, they've got a tax on donations or gifts and inheritance tax. Now, if you are expecting to receive inheritance from parents or grandparents, or your kids would be the most likely recipient, a bunch of the Spanish states have pretty much eliminated inheritance tax. They've made it 99% excluded, so only 1% of your estate is hit by inheritance tax if it goes to your kids, grandkids, etc. In this case, if you are in Andalusia, if you're in Valencia, if you're in the Balearic Islands, if you're in Madrid, you do not need to basically consider inheritance tax or worry about it. However, if you might have a significant potential inheritance, you might want to check the exact state where you're moving to check that there isn't a 20 or 25% potential inheritance tax to be levied. Because the US what's the US general exemption now, Vincenzo? It's gone up to what, 10, 12 million?
Yeah, it's almost 13 actually.
Almost 13.
13 million. Yeah.
Yeah. So you might be thinking, oh, I'm all clear, but just to make sure you're not exposed to Spanish taxation there. Now, beyond that, and this will be one which probably Vincenzo might get shocked by if I haven't mentioned this one before in our previous conversations, the stamp duty and property transfer tax. In Spain, there is a tax every time you buy and sell a property, and the average rate in Spain is 10%. So you buy a property for 100,000 euros, you'll pay 10,000 in taxes and an additional 2% in notary and land registry fees.
Wow.
So what would you guess would happen if we did that, Vincenzo? If we suddenly end up putting a very, very high transaction tax every time something's bought or sold? You're going to guess?
There would be less things bought and sold.
Bingo. So guess what? In the US, property transacts hands every 3 years. In Spain, it's every 60.
Wow.
Property moves hands more commonly because somebody dies than because there is a property transaction. So this is an important part. Why do I say this? If you're a US national and you're looking at moving to Spain, do not jump into buying a property in your first moment. You're used to do it. You think you might be saving rent, but because it's a much less liquid market, really evaluate that before you jump into it. Finally, I'm going to touch on 2 last points before opening up into question. One is the Modelo 720. So just like the FBAR filings, and I've forgotten the other number form for overseas. The eight, what was it?
8938.
8938. Spain's
Yeah.
got their own version. So if you've got more than 50,000 euros of assets, either in bank accounts, securities, and collective investment schemes, or in real estate assets, in any of these categories which add up to this amount, you have to file the Modelo 720 to declare your overseas assets to the Spanish government. So yes, you might very well be in the position of telling the US about your Spanish assets and telling Spain about your US assets to remain compliant on these informative filings.
Wow.
Yes, paperwork and all its glory. Now, Beckham's Law. If you have significant earnings, let's say you've 60,000, 70,000 euros of earnings or more, or you have significant overseas assets, it may very well be worth your while to investigate if you are eligible for Beckham's Law. Beckham's Law is a special regime which basically treats you as non-resident for investment tax purposes and for income tax purposes while you live in Spain. What does that mean? You pay 24% tax on salaries, but all of your overseas passive income, dividends, capital gains, are untaxed. This regime can be applicable for 6 years and also exempt you from filing the Model 720. Who can get Beckham's Law? If you move for an employment contract as an employee of a Spanish entity. If you end up taking the role as a director of a company, which is true economic activity. If you are remotely working as an employee, critically, this does not work if you are self-employed under the digital nomad visa. You must be employed. If you are an entrepreneur and you get approved an entrepreneurship visa, or you get a company which is graded as entrepreneurial. Now, there's a slightly silly thing in this because that classification should be the same as the company director's classification. So they should both be covered by two separate parts of the law. And finally, if you're a family member of somebody who's been approved Beckham's Law, so if your spouse moves for employment, and let's say you're not working, you're retired, your assets can be shielded from Spanish taxation, including, and this is very interesting, the tax authorities have interpreted that pensions are excluded as well. So if you're retired and your spouse is working, you could get your pension shielded from Spanish taxation for those 6 years. What are the critical conditions? You must have 5 years of non-residence in Spain. You must qualify for one of these previous reasons. All job responsibility and tasks must be carried out in Spain. If you do some of that work outside of Spain, it shouldn't be more than 15% of the total work, i.e. you should not be working overseas, let's say 4 months here, 4 months there, 4 months back. You must apply within at latest 6 months of when you arrive. And they sometimes are less likely to approve you if you apply late, closer to that 6-month deadline. The Spanish authorities can be quite erratic in how they treat some of these things. What are the critical disadvantages? This pulls you out of any form of double tax treaty. Now, as a US national, this becomes less of an issue. Why? Because under the double tax treaty, under double taxation agreement, not double taxation agreement, under the US's treatment with the foreign tax credit, Beckham's Law will create a tax credit which can be used back in the US. So there is less of an issue for US nationals in this regard, but it can create issues if you have labor earnings which have already been taxed in another jurisdiction, and then you cannot claim a tax credit on them in Spain. But this is quite minute. The only big area is if you get fired or if you go on maternity leave, those payments, which are usually tax-free in Spain, would be taxed. However, if you have a larger income, 60,000 euros or higher, or you have significant assets overseas, it might be worth investigating to see if you can be eligible for Beckham's Law. Thank you for those who attended, and for those who are going to be watching this on catch up on the video recording. For any questions you have on US taxes, you know where to go with Vincenzo and Online Taxman. For anything to do with Spain and navigating this whole situation, please get in contact with Entre Trámites. It's been an absolute pleasure.
Yeah, thank you, everybody. Have a good day. Thanks, Louis.
Right.